There's no doubt over 5 years we're going to have production shortfalls in a lot of commodities because we haven't invested in productive capacity around commodities for 30 years, and you don't undo that right away. But if we have a serious recession, particularly a global recession, you can have demand falter a little bit. You can have supply falter if demand falters, and you don't get an increase in price. So I think the timeliness of your forecast has to do with whether or not the world or the world's mouth, the United States, enters into a recession. There is zero doubt in 5 or 6 years across a whole range of commodities that we're going to have production shortfalls. The price impact will really have to do with the state of the economy. Looking longer term, what you say is absolutely inevitable. We are still enjoying slow global population growth. We are enjoying in frontier markets rather rapid increases in disposable income at the bottom of the demographic pyramid, the poorest
Mhm.
of the poor. We have succeeded, by the way, as a species over the last 40 years in lifting 2 billion people from dire poverty to merely being very poor, which is a wonderful, wonderful thing, led by the Chinese. And my suspicion and my hope is in the next 20 years, we finish the job. We lift that bottom billion up to the point where they are merely poor as opposed to desperately poor. And when people at the bottom of the demographic pyramid get more disposable income, the goods that generate the most utility for them are physical goods,
Mhm.
material goods. Adam, if you get more money, I mean, yeah, you may buy another couple 50-pound plates to torture yourself in the garage, but mostly what you do is you buy a little gizmo, maybe at our age, a hearing aid or something like that. But when the poorest of the poor get more money, they replace a thatch roof with a steel roof. They replace mud wattle walls with cinder block.
Right.
They go from barefoot to tennis shoes to bicycle to 50cc motorcycle to Toyota Hilux. That is really commodity intensive. I travel the world looking at natural resource projects, and I always keep my eyes open to see how the rural poor are living compared to how they lived when I first started visiting these places. And the increase in material living standards that we're seeing globally is really, really heartening and also really good for natural resource based businesses. I've graded tens of thousands of portfolios for free in my lifetime. And that's allowed me to see the things that most investors get right and the things that most investors get wrong. And further to your comment, the thing that most investors get wrong that's most correctable is that many natural resource investors have good strategy in the sense that they think that there's inexorable demand pull for commodities. But that's a 5 year thesis. And those same people tend to have trauma holding stock over a long weekend. So if you have a long term strategy and short term tactics, the most likely result is that you lose money.
Mhm.
There's no need for this. When people think that their time preference matters, I used to believe that my time preference mattered when I was a young man. I had that beaten out of me. Yes, you want gratification in 3 months so that you get the psychological satisfaction of having been right in an investment. But the truth is, that's not the way the world works. Uh, Most of us are going to be alive 5 years from now, 10 years from now, 20 years from now. And with the challenges that we have in other parts of the economy, like the deteriorating purchasing power of the US dollar, as an example, if you're an American, believe me, doing very well on a stock like Exxon over 5 years, I think is going to come in real handy. The 25-year gradual escalation in the gold price. When people ask me when the gold price is going to rise, Adam, I say, well, I think year 2000. It was 253 bucks an ounce. People were still asking me when the gold price was going to go up when it was at 2,000 bucks. I said, you've had an eightfold move, right?
Right.
That trend in motion, I think, has generated a fair bit of attention now. I think it's fair to say we're in a precious metals bull market. And bull markets follow a very predictable path. The commodity moves first. We saw that in gold. Uh, People are frustrated because the commodity moves, but the equities don't move. We saw that. You may not recall, but I talked about that on your show. Some of your listeners were frustrated about the fact that the gold price had moved, but the gold equities hadn't
Hmm.
moved. That's understandable because gold had a buyer, the central banks, and they don't buy gold stocks. So an asset class that had buyers went up, an asset class that didn't.
Right.
The momentum that was established by the gold price began to give equity investors courage at the same time that the increase in the gold price gave producers better margins. And so now we've seen the best of the best gold producers really start to rip. I mean, the last 18 months have been, from the point of view of the Wheaton Precious and the Agnico Eagles, when these great big guys go crazy,
Yeah.
that attracts attention. And just in the last 15 weeks, you've begun to see retail inflows into the gold equity ETFs. These things follow very predictable paths. I think they follow a predictable path for real reasons. I believe in the United States and around the world that our social debts and deficits exceed our ability to service them in very
Hmm.
simple senses. I'll give you America's math. Our on balance sheet liabilities exceed $36 trillion. And despite the Department of Government Efficiency, the new Trump budget projects the fourth largest deficit in history. The spending increases take place now. The spending cuts take place, if they ever do, 4 or 5 years from now.
Hmm.
But that isn't the biggest problem. The biggest problem is the off balance sheet liabilities. The net present value of unfunded entitlements in the United States, according to the Congressional Budget Office, exceeds $100 trillion. So, Adam, let's add those two numbers, 100 trillion and 36 trillion. That means, as a society at the federal level, before state and local debts, we're 130 trillion net upside down. To put that in perspective, the Internal Revenue Service says the private net worth of American citizens is 141 trillion. So there's $11 trillion margin between what we owe and what we have as private people. But it gets worse. The on balance sheet liabilities of the US government, represented by the deficit, increase at $2 trillion a year. The net present value of unfunded liabilities increases between $2 and $3 trillion a year. The political solution: tax the billionaires. Let's look at the arithmetic there. The private net worth of America's billionaires is $6.7 trillion, according to the IRS, and they ought to know. They got their eyes on it. If you stole all the billionaires' money, not just increased their taxes, but stole all their money, ate your seed corn, you would solve the problem for about 18 months. So what do? What are the alternatives? Well, you could have an honest default. You could say to the bondholders, too bad, so sad, we quit, strong letter to follow. Or you could do what we did in the decade of the 70s. You could devalue the obligation by allowing the purchasing power of the US dollar to decline. And I think that's what's going to happen. In the decade of the 70s, the purchasing power of the US dollar fell by 75%. Not coincidentally, the gold price went up 30-fold. I'm not suggesting the gold price goes up 30-fold from here, but it wouldn't surprise me to see an increase in the gold price that's commensurate with the deterioration of the purchasing power of the US dollar. You're going to go to silver. Silver's a late market mover. The momentum has to be established by precious metals, by gold. When the momentum is established by gold and later by gold stocks, and the generalist investor comes into the precious metal space, it's happened the last 3 bull markets, leadership goes from gold to silver. Not leadership like you've seen in the last 2 weeks, $2 leadership. When the silver market catches on fire, you're not going to need Rick Rule to tell you. People were asking me last week, what do you think about this $2 move in silver? And I just said, I don't think about it at all. I own silver because of quantum moves, and I think that quantum moves are not certain, but more likely than not. I think at the same time that silver moves, the sort of gold exploration companies, the people looking for gold as opposed to having gold, the penny
Yeah.
dreadfuls, really, really, really rip. Well, whether or not that's suitable for your audience is a very different question. I would suggest that we're between a quarter and a third of the way through the bull market. We're just seeing leadership transition from gold to metal to the best of the best gold equities. Now you'll begin to see the best of the best equities enjoy a lower cost of capital, higher share prices than the rest. And you will either see value arbitrage in the market, where people go to the undiscovered parts of the market, or you'll see the big companies take over the little companies. That
Right.
happens in capital intensive businesses. Uh, we've enjoyed a nice move in the gold price. And I'm not sure that the gold price moves up in real terms from here, but it certainly moves up in nominal terms.
Nominal. Hmm.
That's what happened in the decade of the 70s. The first part of the decade of the 70s, the move from $30 to $100 can be explained away simply because it was the private ownership of gold was illegal. And you took the price control off and you tripled the price. I would suggest that the move from 100 to 500, 600 was a response to the deterioration of the purchasing power of the US dollar. And the move from 600 to 850 was simply investors piling on. A trend in motion continues until the morons get massacred. Uh, so I suspect that there's a three or fourfold move in the value, nominal value of the whole complex over 10 years. I don't understand how you resolve the world's political problem. We're going to get out of this just like we got out of the decade of the 70s. But there's going to be a reckoning. And when I say the U.S. dollar is the purchasing power is going to depreciate, I mean in absolute terms. I think other currencies will do as bad or worse.
Right.
I'm
Exactly.
not
Yeah.
suggesting that the U.S. dollar will fall by 75% against the yen or the yuan or the Canadian dollar. I think most of them will do worse than the U.S. dollar. I just think, in an absolute sense, uh, that 2,035 dollars will buy you what 250 $2,025 will buy you.